Welcome all our professional colleagues, student members, and friends of the Institute to another episode of ICAN on Air. Today, 22nd August 2024. Please, if you are wherever you are, please call a friend and tell your friends to join this show again. We have just started. Inform your colleagues and friends that the show has commenced and that they can be part of this show today on ICAN Facebook page or ICAN YouTube channel. And what exactly are we looking at today? IFRS 19, Subsidiaries without public accountability disclosures. And I have here with me an accounting professional, an IFRS expert, the executive director, IQ Strategies Nigeria, and the chairman of Board of Corporate Reporting Faculty of ICAN, in person of Mr. Bolaji Osho, FCA, our own senator, the senator of accounting. So please relax. Don't go away. Today we shall be learning the rudiments of IFRS 19. Let's quickly go and run some commercials. I'll be back shortly with my guest in the studio, and we shall quickly go into the topic for today. Don't go away. Stay back. All right. So let's quickly see the abridged profile of our guest on the show today, in person of Mr. Bolaji Osho. Of Mr. Bolaji Osho. Bolaji Osho, FCA, is a specialist in international financial reporting standards and international public sector accounting standard IFRS, with well over 2 decades in selling personal services covering capacity building, coaching, consulting, and advisory services. He rose to the position of senior finance admin and infotech controller in Trokia Holdings Limited. Bolaji was the chief finance officer of FKG2 Limited and Azagai Limited. Currently, he is the executive director, IQ Strategies Nigeria, and chairman, Board of Corporate Reporting Faculty of ICAN. So we have a very senior man on the show today who is not new to ICAN on Air, but today we want to learn again from his wealth of experience. I have the pleasure to welcome you once again, our own senator. You're welcome to ICAN on Air.
Tosin, thank you very much. Thank you for the invitation, and I'm glad to be here.
Thank you very much. You're welcome once again. When we see you, of course, our members know that all about corporate reporting, IFRS, IFRS. Of course, all their questions would certainly be answered. So let's quickly go into the topic for today. IFRS 19, Subsidiaries without public accountability disclosures. So I go this way. In the words of Bob Proctor, he said, and I quote, "Accountability is a glue that ties commitment to the results." Our global viewers would be happy to share from your wealth of knowledge and experience. In line with International Financial Reporting Standard, IFRS, what exactly is public accountability, and what are some of its principles and characteristics?
Okay, thank you very much, Tosin. Public accountability essentially refers to the responsibilities of entities. Of course, not all entities. So those entities will be entities in the public sector or those whose operations significantly impact public interest. So the responsibilities of these entities to be transparent, answerable for their actions, their decisions, their choices, and their performance. Now, under IFRS, corporate accountability is a key concept that guides financial reporting and ensures entities provide high quality, transparent, and reliable financial information. Now, your question touched on principles, which essentially speaks to the overriding business philosophies. It also touches on characteristics, which essentially deals with the metrics of identification. How do you know those entities with public accountability? I'm happy to go through them, okay? And I hope there will be follow-up questions that will provide opportunity to further deconstruct them. Okay, so these principles are transparency, accountability, stewardship, responsiveness, and perhaps integrity. What about the metrics of identification, which is the characteristics of public accountability? They are financial reporting, in other words, the provision and prompt rendition of high quality, transparent, and reliable financial information. You look at their governance, their oversight, their scrutiny, their consistency, their comparability. So embracing public accountability, entities are able to demonstrate their commitment to transparency, responsibility, and service to humanity, which essentially is needed for maintaining trust and confidence in the capital markets and in the broader economy. Tosin, I yield back.
Thank you very much for that apt response. And like I said again, we are not surprised because we have actually brought the expert on corporate reporting to speak to us on today's topic, IFRS and 19. So let's go this way. I'd like you to refresh our viewers' minds on the subject of subsidiaries, which IFRS 19 is also talking about. In line with IFRS, what are the subsidiaries of a company, and what are the types of subsidiaries that we have out there?
Okay, so thank you very much, Tosi. IFRS 10 consolidated financial statements in the appendix A of that standard defines subsidiary as an entity that is controlled by another entity. Simply put, okay, so the controlling entity is known as the parent company. So when you talk about control, we all know, that it goes beyond just share ownership. You may not even have as many shares in an investing company, yet you're able to determine, or you could be exposed or have rights to variable returns from his involvement with that investee, and also have the ability to affect those returns through the power you have over the investee. Now, you asked the question around types of subsidiary. Broadly categorized, there are basically two. There are subsidiaries that are referred to as wholly owned subsidiary, which essentially implies the parent entity owns exclusively all the rights. In other words, the 100% voting rights in such an entity. Then you have partially owned subsidiary, which means you have some minority interest in the equity structure of the business. Now, those are the two broad categorization. However, within these two classifications, you can also have sub-classifications that fall into some are called special purpose vehicle, foreign subsidiary, and so on and so forth, which could either be wholly owned or partially owned. Tosi, I yield back.
You see, one good thing that I get from your response is that it's so simple, such that even if students are on this show today, they can be putting it down just the same way you are giving the response for a very clearer understanding. I want to say thank you so much for that. So, but still on the subsidiaries that we're talking about, what are some of the corporate benefits and also disadvantages of a company having subsidiaries?
Okay, so thank you very much, Tosin. Benefits of having or gaining control over an investing company, in other words, having subsidiary, there are many, okay, and perhaps diverse. But the first that readily comes to mind is the need to diversify risk, the need to ensure that there are no concentration risks. Dangote PLC is into sugar, is into cement, is into recently oil, is into fertilizer, and so on and so forth. So no matter what happens, no matter the diminution in the economy, no matter the depression in the economy, you will not have the entire organizations or the entire companies in the group all doing badly. So number one can be risk management. Number two could also be tax efficiency. Okay, you could have subsidiary in host countries, no, in offshore countries, I meant to say, where there are favorable tax regime. You know, as an organization, you might want to take advantage of those favorable tax laws, you know, in order to gain tax benefits. So number two is tax efficiency. Number three, we can also have flexibility. Subsidiaries are able to operate independently under independent management, allowing for more flexibility in business decision and indeed strategy. Organizations also develop subsidiaries, either acquire or float subsidiaries in order to have access to new markets. Okay, access to new markets. By that we mean the parent company expanding into new markets in order to expand or increase the reach of his service offering or his product offering. Perhaps another one is innovation. Okay, subsidiary can focus on specific areas which enables the group, as it were, drive innovation and entrepreneurship within the group. Okay, maybe asset protection is another. There are organizations that specifically develop subsidiaries, either float or acquire or spin off, in order to provide protection for specific assets. Okay, protecting them from creditors and legal issues. In some countries, you could also have regulators insisting that an otherwise too large company spin off some into subsidiaries. So these are some of the benefits. What about disadvantages? Of course, there's no benefit without somebody. Number one is complexity. The management of subsidiaries has additional layer of complexity, which requires perhaps additional resources and sometimes infrastructure. Now, maintaining subsidiary sometimes are not cheap. Okay, they can be costly, which includes administrative and legal expenses. What about control and coordination? These are also issues. Okay, if subsidiary run foul of the law or violate a major compliance issue, the reputational risk can rub off on the parent company. So there's potential reputational risk. What about financial burden? If you have a subsidiary as a parent company, you might have reason to support on an ongoing basis. And when we say support, it might be financial, it might be even human. Okay, so that comes as an additional cost. Now, we've seen instances where management of subsidiaries run at cross purposes. So there could be conflict of interest, particularly if the complexity is not well managed. As I close on this, because I recognize we are still in the preamble stage of this conversation and we need to keep it short at the beginning. Okay, the last one I'd like to talk about is exit challenges. Sometimes, as a parent company, if you want to exit from your association or from your involvement with subsidiary, it may not be that easy. So closing or selling a subsidiary can indeed be difficult with potential legal and sometimes financial implication. Now, as I close, let me make this point real quick. The specific benefits and disadvantages will vary depending on the company's circumstances and the purpose for which the subsidiary was acquired or incorporated in the first place. Tosin, I yield back.
Wow, wow, wow. I can tell it categorically that someone who is not on this show today is actually missing because the flow on this topic is actually there. And it's because we are speaking to the Senator of Accounting who understands IFRS in totality. I give it to you, sir. Now, like you mentioned, yes, we are still in the preliminary stage of the questions. IFRS 19 that we are looking at today was issued in May 2024. And if we start, we will apply to annual reporting periods beginning on or after 1st January 2027. However, you agree with me that when this is the best time to understand the standards and all about it is now, and that's why we are talking about it on ICAN on AIR today. So the standards talks about subsidiaries without public accountability. The question is, what are the key facts about this new IFRS accounting standard? What exactly are the key facts and what are the underlying reasons for its development?
Okay, so Tosin, there's so much to unbundle from that single question. So you permit me a bit of time. The standard is not without its fair share of timeline. Okay, the IASB started its agenda consultation in 2015. And then in 2019, research work commenced on it. By 2020, this formal standard setting process began. By 2021, exposure draft was released. The whole of 22 and 23, the IASB spent it on redeliberation. And then the standard was released 9th of May, formally, 2024, with effective date of 1st of January 2027. Of course, early application is allowed. Now, specific facts. Number one, the standard is voluntary. So there's no such thing as a mandatory application, unlike your IAS 16, property, plant, and equipment. unlike your IFRS 16 leases. If you have a lease transaction, you do not have a choice than to apply IFRS 15. IFRS 16, I meant to say. Unlike IFRS 15 too, revenue from contract with customers, as long as you generate revenue that is non-financial, okay, so meaning you are not a financial institution. Even financial institution, they generate some non-financial related revenue, which are incidental to their primary operation. Okay, so the standard is voluntary and allows eligible subsidiaries. Now, I underscore eligibility. So it's not just all subsidiaries. Eligible subsidiaries to apply the recognition, measurement, and presentation requirements of all other standards, but replacing the disclosure requirement with those in IFRS 19. So what it means is a subsidiary that adopts IFRS 19 is under obligation to apply IAS 2 for inventory, IAS 16 for property, plant, and equipment, all right? IFRS 17 for its insurance contract, and so on and so forth, for their recognition, measurement, and presentation. But when it comes to disclosure, even though there's no IFRS 17 disclosure carve-out by IFRS 19, what it means is if you have insurance contract, IFRS 19 has not provided you reduced disclosure requirements. So my point is, any entity that adopts IFRS 19 is expected to apply the recognition, measurement, and presentation applicable in all other standards. But when it comes to disclosure, you come and take advantage of the reduced disclosure requirement in IFRS 19. So if you ask me what is one word that characterizes IFRS 19, I will say is reduced disclosure requirement. Now, you did also ask me, I hope I'm not going too fast. You did also ask me, what is the reason behind developing this standard? I did tell you earlier that the standard began sometime in 2015 when the IASB undertook what we know as agenda consultation. Now, during the consultation, stakeholders said that when a parent company applies IFRS accounting standard in its consolidated financial statement, it requires the subsidiary to report and apply IFRS accounting standard because IFRS 10, paragraph 19, IFRS 10, consolidated financial statement, requires that both subsidiary and parent company use uniform, not even similar, use uniform accounting policy. Now, Tosin, I need you to pause for a moment and sit back. This is where the conundrum lies. When a subsidiary and a parent company apply uniform accounting policy, the question would then be, what kind of policy will a subsidiary company apply that will bring uniformity, that will bring its policies to uniformity? There are just two choices. And those choices are fraught with onerous conundrums. The first choice will be for the subsidiary. Again, we're not discussing the parent company here. The first choice will be for the subsidiary to apply the full IFRS accounting standard. Now, doing so portends some burdensome drudgery for subsidiaries because of the disproportionate amount of disclosures that are required by the full IFRS accounting standards. These disclosures are more often than not too many in terms of line count and too details in terms of disclosure. Okay, so if they apply it, it creates a whole lot of burden on them. And I need you to appreciate the fact that these subsidiaries are not necessarily big companies. They are, for all intents and purposes, they are subset of SMEs. So if an SME, who is a subsidiary, adopt the full IFRS accounting standard, there are issues, maybe not with presentation, maybe not with measurement, maybe not with recognition, but there are usually issues with disclosure. So that is option one. Option two will be for the subsidiary to adopt IFRS for SME. You see, the IFRS for SME uses similar conceptual framework. We recognize that. But the challenge with that is recognition won't be a problem. Measurement won't be a problem. Most time, presentation is also not a problem. Oh, so let me take that back. Recognition, measurement, and presentation are problems. I take that back. Recognition, measurement, and presentations are problems. And I'll give you one classic example. In the full IFRS, we have ECL measurements. What that means is if you have a risk asset in your balance sheet, you must subject that risk asset at the end of every reporting period to ECL. okay, that assesses whether you are doing simplified model or general model. And it's the general model, you are breaking your risk asset into stage 1, stage 2, stage 3. The recognition requirement of IFRS 9 when it comes to ECL measurement, it's a major challenge, usually for a subsidiary. And as a matter of fact, IFRS for subsidiary, IFRS for SME has no similar provision for ECL as we speak. So what have I just said? If the entity adopts IFRS for SME, there will be problems in measurement, problems in recognition. If it adopts the full IFRS, there will be problems in disclosure. This was the problem, the challenges faced by organizations. And they then approached IASB and requested that IASB permit subsidiaries to use IFRS accounting standard, but will reduce disclosure requirement. What that means is these subsidiaries will now have the liberty to use the full IFRS, but addressing or solving the problem of needlessly large disclosure requirements. Okay, that is essentially what the standard is meant to address. So IFRS 9 is the answer to the stakeholders' request, and it permits some subsidiaries, not all, to apply IFRS accounting standard with reduced disclosure requirement. I'm mentioning that for the second time. Okay, so this subsidiary will use the recognition, measurement, and presentation applicable to all standard, but when it comes to disclosure, it comes back to IFRS 19. At the risk of sounding repetitive, the standard is voluntary. Okay, and the subsidiaries and parent company would decide based on their facts and circumstances, based on cost and benefit, whether or not to apply IFRS 19. Tosin, thank you so much for giving me that quality time to deconstruct the thoughts.
All right. I think it's necessary for us to understand exactly what we are talking about. I also want to believe that the voluntary nature of this standard is one of those reasons that makes it different from other standards we've been talking about. Is that correct, Mr. Bolaji?
Okay, so voluntary application of the standard, perhaps yes, but it won't be the only voluntary. Maybe IFRS 14 is also another voluntary standard. Okay, so for now, let me say yes to that question.
Okay.
Right.
Now, you have also explained how the disclosures will be reduced. So let's look at this IFRS 19 vis-a-vis IFRS 12, disclosure of interest in other entities. What percentage of IFRS 12 disclosures would disappear if IFRS 19 for subsidiaries without public accountability goes through or is being applied by an entity?
Okay, so thank you very much for the question, Tosin. The standard has gone through already. So early application is allowed. So by 1st of January 2027, eligible entities will begin to apply them. So Tosin, if I'm to answer your question by providing a quantitative threshold in percentage terms of reduction in disclosure, I'll be too presumptuous. Okay, so what I just want us to accept is the fact that it's going to lead to significantly reduced disclosures for subsidiaries that adopt the standard. Maybe I should also mention, in some instances, there isn't actually any reduction in disclosure. Because if you check IAS 20, accounting for government grants and disclosure of government assistance, the number of disclosures there required by an entity that adopts the full IFRS is actually the same with what IFRS 19 requires that you disclose, even if you take the IFRS 19 carve out for IAS 20. So I do not want us to be presumptuous. Let's just take it that it's going to lead to significant reduction in disclosure. Tosin, I don't know if that satisfies your question.
Okay, it does, and I'm sure it's not just about me too, but also for other viewers and other listeners of the program. But I think that response goes well for it. Okay, so still on IFRS 19, the subject matter for today's discussion. When a subsidiary first applies IFRS 19, can we take that as a first-time adopter of IFRS accounting standards? And then can a subsidiary apply IFRS 19 before applying IFRS 18? Just a two-in-one question.
Okay, I noticed. Okay, so an entity that adopts a subsidiary, because we need to be clear, that adopts IFRS for SME for the first time is by no means a first-time adopter. Okay, a first-time adopter is an entity, IFRS 1, first-time adoption of IFRS. A first-time adopter is an entity that makes an explicit and unreserved statement of compliance with IFRS. So what that means is, if you're a first-time adopter, you hadn't adopted IFRS prior to the adoption of IFRS 19. And there's no way IFRS 19 will be available to you for adoption if you are not already an adopter of IFRS 19. So my first answer is that an entity that adopts, my answer to your first question is that an entity that adopts IFRS 19 for the first time is by no means a first-time adopter of IFRS. That's your first question. Then the second question is, can an entity, please take the second question. Can
a subsidiary apply IFRS 19 before applying or adopting IFRS 18?
Okay, so the answer is a categorical yes. Okay. IFRS 18 is meant to replace IAS 1, presentation of financial instruments. So IFRS 18 is presentation and disclosure in presentation of financial statements, not instruments. So sorry. But IFRS 18 is presentation and disclosure in financial statement. So the standard categorically allows for the adoption of IFRS. When I say the standard, I'm referring to IFRS 19, allows for the adoption of IFRS 19 even prior to the adoption of IFRS 18. Okay? But if that takes place, it means the financial statement of such adopter will be missing in some critical information required by IFRS 18. So IFRS 19 Appendix A3 specifically says if an entity adopts IFRS 19 prior to adopting IFRS 18, then the entity will make certain disclosures. So if you check that Appendix A3, it also refers you to Appendix B2 to B9. Those appendices provides you the kind of disclosure that you will otherwise have made if you had adopted IFRS 18 prior to the adoption of IFRS 19. So the answer to the question is yes, it can be done, but you will still need to provide certain key information, and I can quickly run you through them. Okay, so you provide information about estimation of certainty. You provide information about the fact that you have adopted IFRS. You provide information about if you have changed your accounting policy, the retrospective application you have made, if you have done any prior year correction of error, the retrospective restatement you have made, or retrospective representation. These are the cocktail of information you need to provide if you adopt IFRS 19 prior to the adoption of IFRS 18. Tosin, I yield back to you.
Thank you very much, our own Senator Boladi Osho, FCA, for your responses thus far. Let's quickly go and run some commercials, of course, and like we have usually been saying, we need your support on this program. This is your program, ICAN members. Bring your wares, let's market for you at affordable rates. Let's quickly go and run some commercials. We'll be right back after this time out. Don't go away.
Security is key to national development and growth. No nation can be truly economically successful without peace and stability, or when its security is threatened. This is why we must perform our civic obligation of duly paying our taxes so as to provide the needed resources for government to secure our lives and properties. When we pay our taxes, government is provided with the needed resources to equip our security agencies for a safer Nigeria. The money we pay as taxes is used to purchase equipment and hardware, invest in intelligence and other sophisticated technology, as well as cater for the welfare of all security personnel. A secure nation is a prosperous nation. Nigeria is safer when we pay our taxes. FIRS, it pays to pay your tax.
Dear Dear professional colleagues, the Annual Accountants Conference is here again. This time is the 54th edition. It will happen at Abuja Transcorp Hotel from 7th to 11th of October 2024. Eminent resource persons have been contacted to present papers at the conference. You are hereby invited to attend this conference, and as your Diamond President and Chairman of Council, I urge you to come prepared. You are going to network, make new friends, see other friends that you have not seen for a very long time. Besides that, there will be so many stories, proverbs, and parables. By God's grace, I hope to see you in Abuja, 7th to 11th of October 2024. Thank you, and God bless us.
Join us in Abuja for the 54th ICAN Annual Accountants Conference, a prestigious event and the largest gathering of accountants in Africa. This year's theme, Governance Reimagined, Mapping the Future, from October 7th to 11th, 2024 at the Transcorp Hilton and Abuja Continental, former Sheraton Hotel in Abuja. You will experience world-class and groundbreaking plenary sessions on economic reforms, social contract, and nation building. Explore opportunities in agriculture, export, real estate, technology, logistics, and transportation at our dynamic business workshops. We're excited to offer a world-class conference experience featuring renowned speakers, cutting-edge insight, and unparalleled networking opportunities. To ensure a seamless stay, we've partnered with Arab to provide exclusive discounted rates for conference attendees. Book your accommodation through our dedicated link. We can't wait to see you there. Ready to join this transformative event? Register now at dedicated link below. Need assistance or questions? Let's connect. Reach out to Kunle or Gibson for a personalized support. Don't miss this chance to make a lasting impact. We look forward to welcoming you to Abuja.
The Skill Up Artisans Program Super is an initiative of the federal government.
The aim of Super is to upskill Nigerian artisans for better employability. These were carried out by collecting the data of Nigeria artisans through massive registration, training, certification, and licensing for better job opportunities both locally and internationally. Super will improve the quality of life of Nigeria artisans. It will improve the quality of work from Nigeria artisans, enhance work and professional ethics from Nigeria artisans, reduce dependency on foreign artisans, and increase foreign exchange through talent export.
Log on to super.itf.gov.ng to register now. Super, upskilling Nigeria artisans for super job.
Welcome back to ICAN on Air, your program powered by the Noble Institute of Chartered Accountants of Nigeria. And today we are discussing the topic, IFRS 19, Subsidiaries without Public Accountability, Disclosures. And we have the expert in the house, Mr. Bolaji Osho, FC, our own senator, who has been discussing and answering questions on this topic. Let's quickly go and recognize some of our audience who have been following us since the beginning of this program. Sonny Abdulakim, all the way from Kano. Agai Nok from Abuja. Bulus Makot, streaming live from Jos. We have Musa Aroke from Lagos. Tunde Korede from Lagos, Nigeria. We have Ibukunluwa Deshino from Lagos. We have Muhammad Kuta from Congo. Wow. Shoson Olusoji from Abeokuta, Ogun State. Nochiri Nwabweze from Port Harcourt. Abu Joseph live from Asaba. Vincent Odunakiwale, Akala Olushola from Ogun State, Monsurat Momodu, our regular follower, Onwuma Ernest Chukuma, all the way from Abuja. A whole lot of people have been on the show today, and I can see they're actually following Senator on this topic. Please send in your questions, and I assure you that our guest today is available to answer your question. And that being said, on the other side is the partnership. Like we have been mentioning to you on this show, partner with ICAN on Air. Your wares, your services, your products. Let's make it known to people. Trust us, it's affordable. I'm sure accountants will be like, how much is it? Hope it's not too expensive. I assure you, it is not. Let's do business together. Call the numbers you'll be seeing on the screen very shortly, and let's partner together. So, Prof, Senator, let's continue from where we stopped. IFRS 19 is the subject matter of today's discussion. So let's now look at SMEs. Can a subsidiary whose parent uses full IFRS use IFRS for SMEs if the subsidiary itself is not publicly accountable?
Tosin, thank you very much for the question. The answer is a categorical yes, provided the subsidiary does not have public accountability. It can use IFRS. As a matter of fact, the very fundamental condition for using IFRS for SME is that you must not be publicly accountable. I hope we have opportunity to come back to that. So the answer is yes. However, when a subsidiary uses IFRS for SME, I alluded to it in my last explanation. When a subsidiary uses IFRS for SME for its presentation and preparation of financial statements, what that means is there will be differences in recognition, differences in measurement, and perhaps differences in presentation of elements in the financial statement. What are elements? Elements are the things you see in the financial statement, from position to performance to cash flow. They are basically asset, liability, equity, income, expenses. Okay, the way elements are measured and recognized in the financial statement differs from IFRS for SME and from the full IFRS. I gave an analogy the last time. In the public space, everybody talks about the disruption that ECL brought to the markets. It will interest you to know that there is no equivalent measurement for IFRS for SME as we speak. So if a subsidiary uses IFRS for SME for its financial statement, it still needs to provide additional accounting records to be able to align its policies with that of the parent company. I did mention that IFRS 10 paragraph 19 requires both the parent company and the subsidiaries to use not similar but uniform accounting policy. So the answer is yes, but if that is done, the subsidiary will have to provide additional records with which to align the recognition, measurement, and perhaps presentation of the elements in the financial statement with that of the parent company, so as to be able to consolidate. I don't know if that answers your question, Tosin.
Yes, it does. It does. That's a good one. Okay, so my next question now, can you further illustrate the scope of IFRS 19 using relatable scenarios in order to drive home the boundaries of the standard? In other words, tell us in practical terms how to apply IFRS 19.
Okay, so thank you very much for the question. Let's look at, or let's workshop together 3 scenarios. Okay, so you have a subsidiary A, okay, that has a parent company B. And imagine the subsidiary does not have public accountability. By the way, what does that mean actually, not to have public accountability? I hope we will have opportunity to discuss it, because it is perhaps the foundation upon which every other thing rests.
So I think we should discuss it now. Let's discuss it now.
Oh, okay. Noted. So when is a subsidiary said, when do we conclude that a subsidiary does not have public accountability? A subsidiary does not have public accountability if it meets two conditions. And you have this in IFRS 19, paragraph 11. Number one, if the equity instrument, not just instrument, not equity, if the equity or debt instrument of the so-called subsidiary is not quoted on any exchange or is not even undergoing quotation. So what that means is it's not a listed company. Okay, that's number one. It must meet the two conditions. Number two is the subsidiary must not hold assets in trust for a large group of outsiders. Okay, what that means is the subsidiary must not hold assets in fiduciary capacity for a large group of shareholders. The question you likely ask is, what are the companies, the kind of companies that hold assets in trust for a large group of shareholders, stakeholders? So a bank holds your deposit. Okay, so a bank is not eligible to applying IFRS 19. An insurance company perhaps hold your claims. So insurance companies are not allowed, even if they are subsidiary, they are not eligible. A PFA, okay, pension fund administrator, the fact that they hold your pensions, they are not eligible to apply IFRS 19. Now, I'm also quick to add that just for the reason that an entity holds assets in trust for a large group of stakeholders does not necessarily makes it a company that cannot adopt IFRS 19. There are also companies that hold assets for large group of stakeholders, but not as their primary business. Okay, I'm on IFRS 19, paragraph 12 now. If you hold assets as an incidental part to your primary business, that does not necessarily make you publicly accountable. An example that is standard, paragraph 12 of IFRS 19 cited, you have travel agencies. Sometimes they hold your deposit. You have real estate agents. Sometimes they hold your money. You have clubs. You have charities. You have schools. These entities sometimes have to hold your money, but they do that not as their primary business. They do that as incidental to their primary business. So to that extent, those category of entities that hold assets in trust for large stakeholder groups, but not as their primary business, are not publicly accountable. So for emphasis, an entity is publicly accountable if, number one, it is quoted or is undergoing quotation, or it holds asset as a primary business for a large group of stakeholders. I hope that puts it in perspective. Now, I think your question has to do with we should give relatable illustrations. Okay, so we have a subsidiary that does not have public accountability. By this, we mean, at the risk of sounding repetitive, does not hold assets as a primary business in trust for a large group of stakeholders, and its instruments are not quoted, equity or debt are not quoted. So the entities are not publicly accountable. And then it's a subsidiary. And it's a subsidiary A that has a parent company B. Provided the parent company prepares consolidated financial statements that complies with IFRS, the subsidiary is eligible to adopt IFRS 19. Those two conditions. Number one, it must be a subsidiary, paragraph 11, IFRS 19. It must be a subsidiary. It must not have public accountability. Okay. And what that means is it must not hold assets for a large group of stakeholders. The instrument must also not be quoted. And then the next one is that the parent company must prepare consolidated financial statements that complies with IFRS. If that is the case, then the subsidiary can adopt IFRS 19. That's scenario one. Okay. Parent company prepares consolidated financial statement. Subsidiary is not publicly accountable. Okay. Subsidiary can adopt IFRS 19. Look at scenario two. Subsidiary does not have public accountability, but the parent company prepares consolidated financial statement that complies with local GAAP, not IFRS, maybe US GAAP, and any other GAAP that uses a different conceptual framework from the IFRS. Such subsidiaries cannot adopt IFRS 19. What is the violation there? Of course, the subsidiary does not have public accountability, but the parent company prepares consolidated financial statement that complies with another accounting standard other than IFRS. So if you have a parent company that prepares consolidated financial statement that does not comply with IFRS, the subsidiary cannot adopt IFRS 19. That is scenario 2. Let's look at scenario 3. You have subsidiary A that has an intermediate parent company B, and the intermediate parent company has an ultimate parent company C. So there are 3 entities in this chain. There's a subsidiary. The subsidiary has a parent company who itself is a subsidiary to another parent company. Now let's quickly do a check. When you are looking at the smallest subsidiary, you simply ask the question. Number 1, is it a subsidiary? Yes, check. Paragraph 11, IFRS 19. Number 2, does it have public accountability? No, check. Number 3, does the parent company, which is company B now, prepares financial statements that consolidate, not just financial statement, consolidated financial statement that complies with IFRS? If the answer is yes, check. That means subsidiary A can actually use IFRS 19. But let's look at the intermediate parent company. Recall that intermediate parent company is itself a subsidiary of the ultimate parent company. So let's do a check. Is the intermediate parent company a subsidiary? Yes, check. Is the intermediate parent company publicly accountable? Assuming yes, let's check it. Then the next question is, does the parent company, in other words, the ultimate parent company, does it prepare consolidated financial statement that complies with IFRS? Assuming the answer is no, assuming the ultimate parent company does not prepare consolidated financial statement at all, what that means is the subsidiary company can adopt IFRS 15, but in that intermediate parent company that is itself a subsidiary cannot adopt IFRS 19. Why? Because the ultimate parent company does not prepare consolidated financial statement. I hope this puts it in perspective. Otherwise, during question and answer, we might have opportunity to deconstruct it further and provide some degree of demystification. Tosin, I yield back.
Thank you very much. Thank you very much, Senator. You are doing very well. I think your response on explaining companies or subsidiaries without public accountability was also being asked by Obi Atumoye, and that's why I asked you to actually go ahead and respond to that. Now, let's quickly take a question from our audience. We have Shegun Ayodele Agbolade. He said, what is the impact of IFRS 19 on other disclosure requirements of other standards?
Okay, so Agbolade Shegun Ayodele, thank you very much for the question. What IFRS 19 simply does is to suspend the disclosure requirement in all other applicable standards. So what that means is if you are a subsidiary without public accountability and your parent company prepares consolidated financial statement that complies with the full IFRS, okay? What that means is you can adopt, or rather, you can apply all other IFRS. But when it comes to the disclosure required by those IFRS, you will close your eyes to the IFRS and come to IFRS 19. So essentially, IFRS 19 suspends the disclosure requirement of other standards, okay, and provides you a checklist of highly condensed, highly abridged disclosure requirements in place of the disclosure requirements in other standards. Let me make this point real quick. IFRS 19 did not actually provide us abridged disclosure for all standards. I need to make that point. there are standards that are not covered by IFRS 19. In other words, if you have elements of financial statement that relates to the following IFRS I want to call out, there is no IFRS 19 disclosure carve-outs for them. And the standards are, number one, IFRS 9. There's no IFRS 19 carve-out for it. Okay. IFRS 8. So if you have operating segment, there's no IFRS 19 disclosure requirement for it. Another is IFRS 17. There's no IFRS 19 disclosure, a breach disclosure requirement for it. Another is IAS 28. Okay, investment in associate and joint venture. There's no condensed IFRS 19 disclosure requirement for it. Another is IAS 33, earnings per share. Okay, there's no condensed IFRS 19 disclosure requirement for it. Why did I say this? Just to drive home the point that IFRS 19 did not provide authoritative suspension of disclosure requirements in all standards. It only provides optional disclosure, condensed, reduced disclosure requirement for applicable standards, not all standards. Ayodele, I hope that satisfies your requirements. Otherwise, please come back.
Okay, that's fine. Let's quickly look at the question from Fagbolate Mitokwe. Fagbolate Mitokwe is concerned about your definition of public accountability, and he said the lack of public accountability did mean no accountability in the real sense. But how can the lack of public accountability entrench sound corporate governance?
Fagbola, thank you very much for the intervention. I want us to distinguish between the need for responsible corporate behavior as required by corporate governance principle issued by the Financial Reporting Council in 2018, okay, and the definition of public accountability. And let me make the point that is not my definition, the way you characterize your question. I didn't define public accountability, okay? IFRS 19 paragraph 11 defines it. So you are not publicly accountable if your instruments are not quoted on any exchange and you are not in the process of getting it listed. Number two, you do not hold assets in trust for a large group of stakeholders as a primary business. Okay, that's public accountability. And don't let us confuse it with corporate governance, even though there might be some similarity when you use your logic in assessing them, but they are not the same. The definition are hard-coded in IFRS 19, paragraph 11.
Okay, all right. Senator, let me also ask you one question that I will have also asked if I'm an audience on this show, and that's being realistic. So realistically, IFRS is a technical subject matter, and you agree with me that it could be boring in terms of reading and understanding, but what is the magic to its understanding and easy comprehension that you, Senator, come on the show and you pieces the IFRS? What exactly is the magic for the understanding and easy comprehension?
I listened to your question with complete fascination. You know, it's been said that constant dropping of water hollows a stone. If you find IFRS a major albatross, it's probably because you have not dedicated enough time to it, or perhaps you have not chosen your mentor wisely. Okay. As a person, I studied statistics as my first degree. Okay. It was the need to remain relevant that brought me to ICAN. Okay. So the point is, if a statistician could master IFRS, which is essentially what I sell, that means any other person can do it. So what is the magic? The magic is constant. The magic is you must step up your desire to the level of obsession, and then you will prevail over IFRS with guarantee. I don't know if that answer summarizes.
Wow. Stepping up your desire to the level of obsession. That's I catch that. And it actually got exactly the response I want. In closing, because you don't have much time again, Senator, you agree with me. ICAN is open to ideas that will positively advance the growth of our members. What is your suggestion to ICAN on continuously filling knowledge gaps and to further build capacity and create global opportunities for our members?
Okay, so thank you very much for the question. Let me make this, interestingly, I'm also a member. So I'll be speaking on behalf of myself and perhaps my contemporaries. So let me make this unequivocally clear. The management of ICAN has been doing an impressive job in promoting professionalism, ethical conduct, and excellence in the accounting profession, not just in Nigeria, but in the whole of the West African sub-region. Now, the Institute efforts in setting standards, providing training, and advocacy for the interests of its members have not gone unnoticed. So building on this foundation, whatever suggestion I make today is only intended to further optimize the existing trajectory that ICAN is pursuing. So I'll quickly go through some that comes to my consciousness. Number one, the Institute should continue the model of regular professional development. It is very, very needed. Okay, if you don't use it, you lose it. So if you don't train and retrain your members, chances are that they lose their unique selling points. The second one is to continue the model of global partnership. Okay, collaborate with international accounting bodies in order to provide access to global resources. Maybe another one to consider more rigorously is a mentorship initiative. It will be possible to pair experienced professionals with new members for guidance, for support, for knowledge sharing, and what have you. Another point, perhaps, is to continue the digital learning platform. I know a number of platforms have sprung up in ICAN. You can actually choose to do your development at your pace because of the information superhighway opportunity provided by the information superhighway and the training solutions deployed by ICAN. What about international qualifications? A number of our members have found reason to leave the country recently. Okay, I recognize the fact that ICAN has done a whole lot in partnering with CIMA, of which I'm a member. So if you are an ICAN member, you just write one paper. ICAN should continue in that trajectory so as to increase the mobility of its members in the international space. So if I go to Australia today, I am relevant. Why? Because of my CIMA that I acquired through the partnership with ICAN. ICAN should also expand the frontier with other professional bodies. Maybe continue to host events like we are going to have very soon in Abuja, the annual conference. ICAN should prioritize it even more, membership engagement, because time will fail us. Let me round up on it. So if all these suggestions are implemented, ICAN can enhance the skills of its members, the knowledge of its members, the cognitive abilities of its members, and perhaps the global competitiveness of its members, and ultimately contributing to the growth and development of the accounting profession in Nigeria. Tosin, I yield back.
Wow, Mr. Bolaji Osho, aka Senator, I can agree less with you for your suggestions and for all what ICAN should continue to do for our members. We want to say a very big thank you to Mr. Bolaji Osho, the Executive Director, IQ Strategies Nigeria, and the Chairman of the Board of Corporate Reporting Faculty for coming on the show today and for sharing your wealth of experience with our members. We say thank you very much, Mr. Bolaji.
Thank you very much, Tosin.
Thank you very much. Let's quickly take some announcements that we have for you on the show today. A very important announcement for the whole of the month of September. There will be special episodes of ICAN on Air. As such, ICAN on Air will be run and air on Saturdays for the whole month of September. Please be informed, for the whole month of September, ICAN on Air will be aired on Saturday because there will be special episodes in that month. The second one, join us for the August edition of ICAN Digital Service Hub, where innovation meets confidence. The date is August 27, 2024. The time is 11 a.m. Also, we have the webinar on the introduction to ICAEW. The date is 29th August 2024. The time is 2 p.m. to 3:15 BST. Please join the webinar. It is free of charge. Also, the Governing Council of ICAN cordially invites you to the memorial edition of our doyen, Mr. Akintola Williams. The date is Wednesday, September 4, 2024. The time is 10 a.m. The venue is ICAN Secretariat, Idowuchelo Street, Victoria Island. However, there will be room for many members via the virtual participation. We have the ICAN Entrepreneurship Development Practical Session on 21st to 25th October coming up at ICAN Center, Muwodofin, Lagos. The fee is 40,000. And ultimately, don't forget, we have the forthcoming 54th Annual Accountant Conference. If you have missed the 10% discount on registration in the month of July, don't miss the 5% that is still running till 31st of August. Register today. You cannot miss, or you can't afford to miss that conference. It's taking place at Transcorp Hilton Hotel and also at Abuja Continental Hotel. The theme is Governance Reimagined, Mapping the Future. Coming up between 7th to 11th October 2024. While our time is fast spent and not more time to continue, my conventional colleagues, you agree with me that this program is worthwhile and very insightful. We say thank you for being part of this show today. Till I come your way again with another guest next week, I say stay safe and remain sound. On behalf of the Nigeria team and the producers, I remain Tosin Akinwumi FCA, saying thank you for watching and bye for now.